Welcome to the SafeSimpleSound podcast, where we believe that a secure future is built not by chasing trends, but by resolving the contradictions that keep families up at night. Our mission is to apply S3 approach to financial planning, creating both-and solutions for a complex world. Today, we are exploring a fundamental challenge that sits at the very heart of financial anxiety. It is the topic of our recent writing titled Redefining Risk: Why Safety Isn't the Absence of Uncertainty. We are diving into this because, through our Safe Simple Sound practice, we observe a profound contradiction in American finance. It is a pattern we call the safety paradox. Here's the question we invite you to consider today. Have you ever noticed that the investments which feel the safest often leave you feeling the poorest over time? We are taught from a young age to fear risk. We define risk as the possibility of losing money today. Naturally, we retreat. We move to the safety of cash, savings accounts, or guaranteed instruments. It feels responsible. It feels safe. Yet, 10 years later, many families find themselves in a difficult position. They haven't lost a single dime on paper. Their balance is intact, but they can buy significantly less than they could before. Their lifestyle has shrunk, even though their account balance didn't. In our desperate attempt to avoid the volatility of the markets, we often walk directly into the guaranteed erosion of inflation. In this episode, we are going to dismantle the fear surrounding the word risk. We are going to look at it not through the lens of emotion, but through the lens of our framework. Whether you are approaching retirement and terrified of a market crash, or you are in your accumulation years trying to decide how much cash to hold, this episode will provide you with a new definition of safety. We will move from an either-or mindset, where you think you must either gamble or hide, to a both-and solution. We will show you how, from a safe, simple sound perspective, you can accept short-term uncertainty to gain long-term security. Let's begin by redefining the terms. To understand why traditional advice often fails us, we have to look at how we define the word risk. At Safe Simple Sound, we believe you cannot build a secure future until you redefine what risk actually is. In our culture, risk is often painted as a monster to be hidden from. But in our framework, risk is not a monster. It is simply a deviation to be managed. There is a distinct gap between how our brains process risk and how financial mathematics processes risk. We call this the difference between the emotional definition and the mathematical definition. Let's explore the emotional definition first. This is where most of us live. If our team were to ask a room of 100 people to define investment risk, 99 of them would say something like, "The chance I lose my money." This is entirely natural. It is rooted in our survival instinct. Throughout human history, our brains have evolved to keep us safe from immediate physical threats. When the stock market drops 10%, our amygdala, the ancient part of our brain, registers this as danger. It feels exactly the same physiologically as seeing a predator in the bushes. The instinct is to run, to hide, to protect what we have. This reaction is safe in a biological sense. It kept our ancestors alive. But in a modern financial context, this instinct can lead us astray. Drawing from our CFC background at Safe Simple Sound, we look at the mathematical definition. In the world of sound financial planning, risk is simply defined as the deviation from an expected outcome. Let's make this simple. If you expect a 10% return on an investment and you get 15%, that is technically a risk because it deviated from the expectation. If you get 5%, that is also risk. It is just movement. It is just data. In the S3 framework, we don't fear deviation. We plan for it. We anticipate it. We know that the line on the chart will wiggle. The problem arises when we confuse two very different dragons or types of danger. To live a contradiction-free life, we must distinguish between permanent loss and volatility. Let's break these down, because understanding the difference is the key to sleeping well at night. First, there is permanent loss. This is when an investment goes to zero or drops and never recovers. Think of a specific company going bankrupt or a speculative cryptcoin that vanishes overnight. When you experience permanent loss, the money is gone. It does not come back. This is true risk. This is what we want to avoid at all costs. Second, there is volatility. This is when an asset's price fluctuates up and down, sometimes violently, but retains its fundamental value and recovers over time. Think of the broad US stock market or a diversified portfolio of thousands of global companies. We call volatility noise. The market goes up, the market goes down, it reacts to news, elections, and global events. But historically, diversified markets have recovered and grown. The critical mistake we see families make, and this is the heart of the safety paradox, is treating volatility like permanent loss. When the market dips, which is just noise, our emotional brain screams predator. We panic, we sell, and in that moment, we turn a temporary mathematical deviation into a permanent, lifestyle-altering loss. We turn noise into damage. From a SafeSimpleSound perspective, we want to help you reframe this. We want to validate that the fear is real. It is your brain trying to protect you. But the action of selling is often what causes the very harm you are trying to avoid. So, how do we solve this mathematically? How do we build a plan that respects your need for safety, but doesn't succumb to the erosion of inflation? We use a foundation-first equation. In financial theory, we say total risk will systematic risk plus unsystematic risk. Now, that sounds technical, so let's apply the simple principle and use an analogy. Systematic risk is like the weather. It is the storms, the tides, the seasons. It encompasses interest rates, recessions, and wars. You cannot control the weather. No matter how good your plan is, it will rain sometimes. In the market, rain means the value of your account will fluctuate. Unsystematic risk is like a house fire. This is a specific disaster that happens to one specific property. Maybe the wiring was bad, or someone left the stove on. This is the risk of holding just one stock, or putting all your money in one sector. Here is the insight. True safety doesn't come from avoiding all risk. That's impossible. You cannot stop the rain. True safety comes from eliminating the unsystematic risks, the house fires, through diversification. We make sure you don't own just one house, you own the whole neighborhood. And then we manage the systematic risks, the weather, so that your house is built strong enough to withstand the storm. We don't try to predict the weather, we build a waterproof roof. This is a crucial shift in thinking. We stop trying to control the uncontrollable, and we focus entirely on the structural integrity of your financial plan. To illustrate how this principle plays out in real life, let me share a hypothetical scenario. While this story is fictional and created for educational purposes, it demonstrates patterns we frequently observe when families grapple with the safety paradox. Let's imagine a couple named Robert and Sarah. They are 62 years old, approaching retirement in just a few years. They have worked hard, saved diligently, and built a nest egg of $1 million. Robert and Sarah remember the financial crisis of 2008 vividly. They remember the fear they felt when they opened their statements and saw the numbers drop. They promised themselves they would never feel that way again. So, as they approach retirement, their emotional definition of risk kicks in. They look at the stock market, which seems high and volatile, and they think, we can't afford to lose this money. We are too close to the finish line. In our hypothetical scenario, Robert and Sarah decide to move their entire $1 million into a high-yield savings account and certificates of deposit. On day one, they feel an immense sense of relief. This is the safe aspect of their decision. They have eliminated volatility. If the market crashes tomorrow, their statement will not change. They have achieved safety by the emotional definition. But let's fast forward this story 10 years. Robert and Sarah are now 72. They have been drawing on their savings to live. However, something subtle and insidious has happened. While they eliminated the volatility of the market, they walked directly into the path of the inflation dragon. Historically, inflation averages around 3%. This means the cost of milk, bread, gasoline, and healthcare doubles roughly every 24 years. But even in a shorter window, the erosion is painful. In our scenario, after 10 years, their $1 million, even with the interest they earned, buys significantly less than it did when they were 62. Their purchasing power has eroded. They start to realize that to make their money last, they have to cut back. They travel less. They worry about the heating bill. They hesitate to buy gifts for the grandchildren. This is the tragedy of the safety paradox. By trying to be safe from the market, they became unsafe in their lifestyle. They traded the noise of volatility for the permanent loss of purchasing power. Now, let's pause the story and look at how a SafeSimpleSound approach would have handled this situation differently for Robert and Sarah. While this is fictional, it allows us to apply our sound principles. If Robert and Sarah had worked with a framework, we would have helped them distinguish between the money they need now and the money they need later. We would have said, Robert, Sarah, we validate your fear. It is scary to see the market drop. So let's take the money you need for the next 2 to 3 years, your grocery money, and keep that perfectly safe. Let's put that in cash or short-term bonds. That way, when the market storms, your immediate lifestyle is dry and secure. However, we would continue. The money you need for age 75, 80, and 85 needs to grow. It needs to fight inflation. We must expose that portion of your money to the market. By doing this, we move from an either-or mindset. Either we are all in cash or all in the market, to a both-and solution. We accept short-term volatility on the long-term money to gain long-term purchasing power security. In this alternative S3 version of the story, when the market dips, Robert and Sarah don't panic. Why? Because they know their next 3 years of income are safe. They don't need to sell the long-term investments while they are down. They can wait for the weather to clear. This is how we apply the distinction between systematic and unsystematic risk. We accept the systematic risk, the market volatility for the long-term growth, but we insulate their daily lives from it through proper allocation. Through this example, you can see how thinking applies. It's not about ignoring risk, it's about matching the type of risk to the timeline of the money. Cash is risky for long-term goals because of inflation. Stocks are risky for short-term goals because of volatility. We see this pattern constantly in our practice. Families feel they must choose one camp or the other. They identify as conservative investors or aggressive investors. Our S3 framework suggests that you need to be both. You need to be conservative with your rent money and aggressive with your legacy money. Whether you are facing this exact scenario or simply wondering if you're holding too much cash, the principle remains the same. We must adopt a vision-first approach. Consider the trustworthy tortoise perspective we often discuss. If you bury your money in the backyard or leave it in a checking account, you have zero volatility. It feels safe. It is the ultimate tortoise move, right? Actually, no, because a tortoise also needs to eat. If your money is losing half its value every 24 years due to inflation, that isn't safety. That is a slow, guaranteed leak in your financial boat. From a SafeSimpleSound perspective, this provides the stability we look for. Stability of lifestyle, not just stability of account balance. We often tell the families we serve, we don't care if your account balance fluctuates, as long as your ability to buy groceries and visit your family does not. That is the distinction. That is the redefinition of risk. As we bring this episode to a close, let's summarize the insights we've explored today regarding the safety paradox. First, we recognize that safety is not the absence of uncertainty. Trying to eliminate all uncertainty usually leads to the guaranteed certainty of purchasing power loss. Second, we distinguished between the emotional definition of risk fear of loss and the mathematical definition deviation. We learned that your brain treats a stock market dip like a predator, but your plan should treat it like weather, something to be prepared for, not feared. Third, we identified the two dragons: permanent loss, the true enemy, and volatility, mere noise. We discussed how reacting to noise is often what causes permanent loss. And finally, through our hypothetical story of Robert and Sarah, we saw the power of the both-and solution. You don't have to choose between safety and growth. You can structure your financial life to have safety for today and growth for tomorrow. You don't need to fear the market, but you do need to understand it. The first step to financial peace is admitting that hiding in cash is not a strategy. It's just a different kind of risk, one that moves slowly, silently, but destructively. So what is the next step for you? From our SafeSimpleSound perspective, the path forward is clarity. You need to know which risks you are actually taking and which ones are illusions. This episode draws from our recent blog post, Redefining Risk, which acts as the first pillar in our series on financial foundations. You can find the complete written framework at SafeSimpleSound.com. But beyond the blog, our team has created a specific resource to help you apply this thinking to your own situation immediately. Through our S3 approach development, we've created the S3 Risk Redefinition Compass. This is a simple tool designed to help you visualize your position. It separates emotional fear from mathematical fact and shows you exactly where your portfolio stands on the safety paradox curve. If today's S3 insights resonate with your family's situation, if you recognized yourself in the story of Robert and Sarah, or if you've been feeling that tension between safety and growth, we invite you to download this compass. It is available for free on our website. It is an exercise in educational generosity. Whether you ever choose to engage with our practice or not, we want you to have this capability. We want you to be able to look at your money and know the difference between a house fire and a rainstorm. If you find that you need guidance in building that waterproof roof, we invite you to explore what financial planning could look like through our SafeSimpleSound practice. We are here to help you construct a plan that is safe, simple, and sound. Until next time, remember, true safety isn't about hiding from the future. It's about building a framework that allows you to face it with confidence. Thank you for listening to the Safe Simple Sound podcast.